As of the close of the stock market on Friday, May 15, 2026 at 4 p.m. Eastern Time, Navitas Semiconductor stands at a price of $21.32 per share, marking an intraday drop of 4.48%. This single-session pullback occurs right after an extraordinary stretch where the stock went almost vertical, forcing market participants to pause and look closely under the hood of this specialized chipmaker. While standard headline tracking might blame this daily dip on broad tech sector volatility or typical profit-taking after a massive spike, the actual mechanism moving the tape right now is an intense tug-of-war between aggressive institutional short sellers covering their positions and structural options volume adjusting to a massive product pivot. The prevailing market narrative surrounding Navitas Semiconductor has long been that it is merely a niche component provider tied closely to consumer electronics, a business vulnerable to cyclical slowing and margin pressure from larger competitors. Many retail investors and self-investing advocates who frequently screen for high-growth tech opportunities on common investing sites or look for emerging tickers via their Robinhood app have viewed this company as a speculative, cash-burning bet on basic power adapters. The conventional belief is that until a semiconductor firm shows clean, unadjusted net profitability, its equity is too volatile for an individual brokerage account focused on long-term wealth accumulation. This perspective leads many to look instead at massive stable entities when choosing where to deploy capital, assuming that smaller players cannot withstand macroeconomic headwinds. The underlying reality completely challenges that surface-level view, especially when analyzing the structural mechanics behind the recent price action. Navitas is currently executing a deliberate, massive corporate transformation away from low-margin mobile accessories and shifting entirely into high-power applications, specifically targeting the power infrastructure requirements of artificial intelligence data centers. In the most recent first-quarter earnings report, this strategy showed its first major proof point when revenue crossed $8.6 million, outperforming consensus projections. While a casual look at a standard interactive brokers platform might show a GAAP net loss that looks concerning on paper, institutional capital noticed that the company's high-power segment grew 25% year-over-year. This specialized portfolio now dictates the majority of the business trajectory, forcing major investment banks to completely recalibrate their mathematical valuation models. This massive tension between expectation and reality is exactly what sent the stock ripping from the low teens up into the 20s over a matter of weeks before this recent minor consolidation. Professional traders using a premium interactive brokers trading infrastructure or executing complex strategies through high-end individual brokerage accounts recognized that Navitas had a massive short interest, tracking near 21% of outstanding shares. When the company confirmed a major licensing partnership to power data center infrastructure in expanding international markets, it acted as a catalyst that completely broke the bearish thesis, triggering a rapid short squeeze. This technical phenomenon is a great example of why active market participants look beyond standard passive funds like Fidelity ETFs or broad index products when hunting for alpha. When you examine the current daily swings and trading volumes, it becomes clear that institutional activity is entirely dictating the price action. The volume spike accompanying the recent run to $22 was multiple times the historical daily average, indicating that large block orders rather than small retail accounts were driving the tape. This is not the type of momentum usually seen on standard online investing platforms where retail buying creates slow rolling trends. Instead, this has been an aggressive institutional repricing event, where analysts at major firms like Baird and Needham dramatically lifted their price targets toward the $20 mark practically overnight. For individuals managing their own capital through self-investing or utilizing automated platforms like Schwab Intelligent Portfolios, this sudden shift emphasizes the importance of tracking institutional fund flows rather than sentiment alone. To understand the core engine behind this stock movement, we must look at what Navitas Semiconductor actually does from a functional standpoint. The company designs and manufactures next-generation power semiconductors utilizing gallium nitride and silicon carbide instead of traditional legacy silicon. These advanced materials allow power systems to operate at much higher voltages, efficiencies, and frequencies, while drastically reducing the physical footprint of the components. In practical terms, when an organization is building out a massive server farm to process intense artificial intelligence workloads, the electricity demands are astronomical. Traditional power management setups lose significant energy to heat, requiring massive cooling systems and driving up operational costs. By integrating these advanced materials, data center operators can achieve significant efficiency gains, which directly impacts the bottom line of cloud computing providers. The business model relies on securing design wins with major hardware manufacturers and cloud infrastructure developers. In the past, the company was heavily dependent on the mobile market, supplying fast-charging components for smartphones and laptops. However, management recognized that consumer tech is highly cyclical and suffers from intense pricing pressure, which compressed corporate gross margins. The deliberate decision to exit these legacy consumer lines caused short-term revenue declines when comparing current figures to older annual reports, which is precisely why the stock was heavily shorted throughout the past year. Bears misread this planned reduction in mobile revenue as a sign of structural decline, failing to see that the high-power pipeline was filling up rapidly with data center, industrial, and electric vehicle contract designs.
This brings us to the core financial conflict that investors must navigate when managing their allocations through a Fidelity brokerage account or any online investment platform. On one hand, the company is still losing capital on an unadjusted basis, showing an operational loss of $11.7 million in the recent quarter. For conservative wealth managers who build portfolios using traditional Fidelity mutual funds or stable blue-chip individual equities, a cash-burning semiconductor stock trading at an elevated price-to-sales multiple represents an unacceptable level of risk. On the other hand, the corporate balance sheet remains highly resilient, showing $221 million in cash and cash equivalents with zero outstanding debt. This financial cushion gives management a long runway to scale production without the immediate threat of dilutive equity offerings or high-interest corporate debt burdens. Comment below how many shares of Navitas Semiconductor you currently hold in your portfolio, or if you prefer sticking to larger chip companies. Looking at the near-term future, the forward-looking guidance provided by executive leadership points to a clear sequence of operational milestones. Management expects second quarter revenue to rise to approximately $10 million, representing double-digit sequential growth alongside a steady expansion of gross margins toward 39%. The legacy mobile business is projected to shrink to an insignificant fraction of total revenue by the end of the calendar year, completing the corporate transition to a pure-play high-power component provider. This clear path toward a cleaner product mix is the primary reason why momentum traders are treating the equity as a live wire for active position management rather than a simple buy and hold asset. The macroeconomic environment adds another layer of complexity to this entire setup. The global push for data center efficiency is no longer just a corporate preference. It is becoming a regulatory and economic necessity as power grids face unprecedented strain from the build-out of artificial intelligence clusters. This broader shift means that demand for advanced power semiconductors is relatively insulated from standard consumer economic slowdowns. Even if consumer spending weakens and impacts general retail trading activity across platforms like the Robinhood app, institutional demand for enterprise-grade power infrastructure is expected to remain robust. This structural decoupling is a critical factor that specialized component designers apart from the broader, more cyclical technology sector. As we look toward the final half of the year, the ultimate investment thesis for this equity will be determined by how reality measures up against these heightened market expectations. The bulls believe that the company's recent technology showcases, including advanced power delivery boards displayed at major industry conferences, will translate directly into multi-million-dollar production orders by early next year. The bears conversely maintain that larger, well-capitalized legacy chipmakers will eventually build competing silicon carbide and gallium nitride portfolios, squeezing the smaller firm out of major data center contract wins. This classic divergence of outlook ensures that the stock will continue to exhibit high beta and wide trading ranges, making it essential for investors to maintain strict risk parameters, whether they trade via sophisticated interactive brokers accounts or simple retail interfaces. In summary, Navitas Semiconductor is no longer the simple consumer electronics story that the market expected it to be throughout last year. The underlying reality reveals a rapidly adapting enterprise, aggressively embedding itself into the structural architecture of next-generation artificial intelligence infrastructure. While the daily drop to $21.32 highlights the inherent volatility of a high-growth, non-profitable tech stock, the underlying financial metrics, lack of debt, and sequential revenue growth indicate a fundamental turnaround is underway. The historical data shows where the business struggled, but the recent price action and institutional volume clearly demonstrate that the market is beginning to price in a completely different corporate profile moving forward. Investors must balance the risk of an elevated valuation multiple against the clear operational momentum as this specialized chipmaker attempts to solidify its position in the rapidly expanding data center landscape. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video. Comment your thoughts. Outshare with your friends. Bell subscribe for more updates.